Okay, hello everyone. Welcome to the second lecture of Management 202. So this lecture will be about two things, right? So we will have two parts, right? The first part is introductory on the nature of the firms, right? So the slide title is called Theory of the Firms. And after we finish this one, we'll jump into capital budgeting, right? The first part of capital budgeting. All right, so let's get started. So the outline of this slide is to talk about some basic understanding on firms, right, or the nature of the firms, right. So first of all, why do we have firms to begin with, right? So this sounds like a really fundamental and somehow silly question, but it's actually quite important, and people have different answers for that, right? Second of all, we're gonna ask the forms of firms, right? Different type of firms, right? Depending on the size of the firms and also the function of the firms, right? And then we'll talk about the different structure of the firms, and finally some conflicts within the firm, right? And we'll explain what conflicts will arise when we have different kinds of firms, and how does that explain, right? Back to the first question, why we have firms at all. Okay, so let's get started. So let's say start from a very simple example to illustrate, right, why firm arises. So let's say we have two guys, right, Tom and Jerry, right? There are two lemonade stand owners, right, on both sides of the street, right? Say Tom is on the east side of the street, and Jerry is on the west side of the street, right? So they each own, one side of the street, and they sell lemonades to make money for themselves, right? So they have a lot of similarities, right? You can say they have. So first of all, it's completely the same lemonade, right? And they will encounter very similar cost of productions, such as buying inventory, right? They need to do marketing, and they also need to do logistics, meaning like shipping their stand and shipping the materials to the location where they are selling the lemonade, right? And also they encounter a similar type of risk, right? Meaning that they are on one side of the street, meaning that they will likely lose customers from the other side, right? And maybe more importantly, one thing they also face is each other, right? So they also face competition from each other. And if Tom sells lemonade at $3 a cup, and making a profit of $1, right, at a cost of $2, then Jerry would have the incentive to sell the lemonade maybe at $2.50, right? And people will find he has a cheaper price and all comes to his stand to buy the lemonade, right? So, and this type of thing can keeps going, right? And in the end, they might find both of them selling a lemonade, right, at $2 each, right, and making, well, barely, break even for their cost of goods sold, right? So this is what will comes from the competition, right, from each other, right? So the consequence is quite natural, right? They each will earn a very low profit, right, on their lemonade, and it's bad for both of them, right? So let's say somehow, right, they realize that this is a problem, right? And this is, rather than keep pressing down our sales price, why don't we work together and own the street together, right? So you own the east side of the street, I own the west side of the street. That's great. It means that not only we can basically gather all the customers along the street, we can increase our scales of sale, right? We can increase our revenue, right? And there's less risk of missing the customers from the other side of the street, right? And also there's likely to be a higher productivity, right? Meaning that probably it's less costly if we buy the raw materials together, right? In a larger scale, and it's probably less costly if we manage the stats together, right? So we don't need to worry about what the other guy is doing, and we can just put more of our energy and attention on making better lemonades, right? And of course, there will be less competition, right? Meaning that instead of worrying that the other guy is selling at a lower price, well, maybe we can just both sell lemonade at $3, right? Since now we're working together, we're like partners, right? So why don't we just both sell the lemonade at $3 and make $1 profit for each cup of lemonade that we sell, right? So that's great, right? So here are all these benefits, right, for individuals to form partnerships or to form alliance, or basically this is something like the most fundamental thing, right? Most fundamental, or most the easiest format of a company, right? Of a company. So these are all the benefits, right, for starting a company from individuals that operates the same functions or operates in the same business, right? So here you might want to ask a question that, well, let's say if this is the case, right? Can every competitor, right, in the same industry or doing similar business, can they just ultimately form one firm which will, ultimately control 100% of the market share, right? Let me pause here for 1 second, and you might have an answer in your mind, right? So the answer is, well, theoretically they can do it, but in reality, probably not, right? So first of all, well, there is this invisible hand by the market, right? Meaning that, well, yes, you can definitely form a bigger organization, like the reality for a lot of industries right now, right? Maybe only the top 3 or top 5 players control 90% of the markets, right? However, if you sell the price too high, there's always this incentive, right, or attraction for new companies to jump in the market, right? So let's say Tom and Jerry decide that, well, we're going to both sell the lemonade at $3 a cup, right? And now Mike knows the situation and say, well, why don't I join their competition and sell at $2.50, right? I can still make 50 cents. It's not as much as $1, but I think it's good enough for me, right? So if the price is not competitive, it will always be, attracting. It will always be attractive to new competitors, right? New companies or new competitors will always have this incentive to join in if they see the room for making a profit, right? And second of all, there's this antitrust laws that prevents a certain type of monopoly or activities that these big companies can do to hurt fair competition, right? So in both ways, right, it is not very likely that one organization or one company can control the entire market, right? So what you see in reality is that it is right, very likely that we're going to have a small number of companies control the very big shares, and there are many other small firms who eat the maybe the 10% or 5% left of the entire cake, right? So this is the case. Okay, so that gives us, the first reason why we have a firm to start with, right? So if you have a goal to maximize your profit of the business, right? Meaning that through certain ways, like increasing the scale, reducing the risk, right? Increasing your efficiency in production, right? And of course, reducing competition. If these are all the ways, for you to increase your profit, then maybe a firm makes more sense than competing with others like individuals, right? Okay, so here's the thing, right? When Tom and Jerry decided to work together, right? So you will have some issues when working with others, right? Just like doing a case project in a group, right? A group project. So there's always different incentives for different people, and some of them arise from the nature of those peoples, and some of them arise from just the incentives, right? So let's say Tom and Jerry are now partners, right, in selling lemonade, right, on both sides of the streets. And let's say Tom is, an elder person, and he gets tired after working for maybe, I don't know, 5 6 hours, right? So here's what he says to Jerry, right? So, well, I'm getting tired, I'm old, so why don't you hang on, and I'll just go home after 6 hours working a day. Okay, so this is something that Tom might do, right? So in a group case scenario, right, some people might not want to join a discussion for as long as the other people wishes, right? So it's very similar, right? And also, right, another example is that Tom wants to hire his lazy friend Butch, right, which is this black cat, right, to as an assistant, right, as an assistant for him to to sell the lemon stand, to sell the lemonade for him, right? So, and another example is that Tom maybe wants to use the money that they put together, right, in their partnership to buy a truck, right, that he claims to use for shipping lemons, but very likely to use for his own convenience because he's the one that's holding the key for the truck, right? So these are all decisions that could be made by individuals in a company, right? Sometimes by the CEO of a company, which all sorts of make sense for the company's project, but might hide the personal incentives from these individuals, right? From CEOs, right? So if Tom did the following things, right? What would the Jerry think, right? What would Jerry think, right? So if you are Jerry, you are the other partner. What will your reaction be, right? Given Tom's suggestions or Tom's decisions, right? So it's very likely that you would not be very happy about it, right? So this is probably what Jerry's reaction will be, right? So here comes the second theory of the firms, right? So why would a firm exist, right? So if you think about the different decisions that people can make, right, for themselves, right, once they are a part of the firm, then a firm is actually can be thought of as a combination of the contracts between the firm's employees, right? So in this case, contracts are very important, right, to make the firm work, right? Especially when people have different natures and people have different incentives, right? No one wants to work hard, but everyone wants to share the profit, right? So that's the thing. How do we align their incentives so that everyone can work hard, or at least make their efforts, right, to the firm? So that's why we need a contract, right? So the contract would generally define at least two things, right? So the first thing is that it defines the what the employee should and should not do, right, towards the company, right, for the benefit of the company. And second, right, it defines sort of like the duty of the company on investors, or the duty of the company on its employees, right? So basically, you can think of that sort of like a compensation, right? So how much money would the company offer the employee for their services, right? And what are some other privileges such as insurance, retirement account, medical coverage, right? Things like that, right? So certain privileges that the companies can offer the employee as compensation, right? So when you think of a contract, right, think of the contract on both sides, right, meaning the duty of the employee to the firm and also the duty of the firm to the employees, right? So it should be mutual, right? And the contract should discourage, agency issues, right? So here, what does agency issues mean, right? So agency comes from the word agent, right? Meaning that, if we think about people's or employees or the parties that are similar within the firm, right? We can sort of think of a firm employee as an agent, right? So you can think of debt holders as an agent. You can think of equity holders together as an agent, right? You can think of manager as an agent, right? So it's just a way to represent a special uh, a special group of party who shares the same interest, right? And so here are some examples of agency issues, right? So the agency issues is a negative word, basically. It describes this decisions that would hurt the value of the firm, right? So the first one is what we call free riding, right? So what does free riding means, right? Meaning that you are riding a bus without paying the bus tickets, right? So basically in corporate finance, in these scenarios, right, it means that one agent of the company is not making his own efforts, but get to share the benefits, right, arise from the efforts of others, right? So looking back to the example that we have shown, right, on the last slide, right? So Tom is elder, right, and wants Jerry to work longer, right? So what will happen if he does that? Right? So he makes less efforts to the company. However, he, as a partner, shares, the profits of the company, right? So let's say they are 50-50, right, in terms of ownership of the company. Then they should both make 50% of the efforts and share 50% of the profits, right? So if one party decides to slack, but still share the same amount of profits, so it means that he's free riding on the other guys, right? So this is the free rider problem, right? And the second problem is what we call moral hazards, right? So if you think slacking or not making efforts, right? If you consider this action to be immoral, right? Then you can think of free riding as one example, right, of moral hazards. But moral hazards refers more to particularly those decisions that hurts the company's value, right? That hurts the company's profitability, right? While it's self-benefiting, right? So if you go back to the previous slides, as we see that if Tom wants to, hire his relative or his friend as the employee, right, and pays him wage, regardless of the ability of the employee, right, regardless of the performance of the employee, just because they have good relationship, then that's something that might be considered as moral hazards, right? And some other examples include, that a party of the company make transactions with another company, right? That he has personal connection with, right? And then he will, receive money right under the table for doing that, right? So that's something that's what we call moral hazards, right? Self-benefiting while hurting the company, right? It's not the best decision that the company should make. The decision is only made because the agent wants to get perks, right, for himself. And so here are two types of agency issues, right? So when we get into more details about, especially public companies, right, public listed companies or C Corp, then we can talk more about agency issues. But, these are just some quite straightforward, quite typical agency issues that can happen, right, if the contract of the company is not well defined, right? So this is basically what a contract should do, right? Should prevent, right? So to prevent this agency issues, the contract should, be able to align the incentives of all agents, right, to work best of a company, right? How do you stop free riding? Right. So for many companies, they have these KPIs, right? So you have to achieve a certain level of performance, right, as an employee, right? And your performance will be compared with other employees, right, to make sure that you're not slacking and you're doing a job that you are expected to do, right? And there will be bonus, which is sort of like some incentives to reward you if you work harder and if your performance is better, right? So these are all some things that a firm can specify in a contract with an employee, right? So that employee will work hard for the company's best, right? So this is basically how we understand the theory of a firm instead of contract theory, right? Instead of in terms of a contracting theory. Okay, so say Tom and Jerry's firm is doing pretty well, and they start thinking about expanding their businesses, right? Maybe not just by doing lemonade stands, maybe opening a store, right? And if the store's business is good, maybe start thinking about opening the stores in a chains, right? Doing a chain store. So there are different ways to grow their businesses, right? And something that they most likely will encounter is that it's not a two-man job anymore, right? Or it's not a two-cat mouse job anymore, right? So they need different talents on other things, right? So they might be very good at making lemonades, or let's say they have a secret recipe in making lemonade, so everyone love their lemonade, but they might not have the expertise on a lot of other things like doing accounting, right, which is quite crucial for a company to operate, right? They might not be an expert in marketing, right? They might not be an expert in logistics or in many other things, in legal issues, right? Right. There are many other things that require other talents for the company. So if they want to grow their businesses, they need to hire other talents to do these jobs, right? And then, here we will have a hierarchy for a firm, meaning that if Tom and Jerry are the founders and they are the owners, and they are likely to be managers, right? Or if they want to, really hire someone who knows how to manage a company, they can hire someone from outside to be as managers of the company, right? And then further below, we will have employees from other departments, from different departments, right? Accounting, legal, right? Who are all under the commands of the managers, right? Who represents the interests of the owners, right? Okay. So here's basically how firm will start to develop, right? As the size increases and as the number of employee or number of parties increases, right? So I think so far here it's quite reasonable, right? So we've talked about two angles to how to think about firms, right? First one from profit maximization, right? And the second part is from the contracting, right? And they actually these two are actually consistent with each other, right? So to make profit maximization easier, right? We need good contracts that can align incentives of different people, right? So people are working their best, right, to increase the value of the firm, right? So here comes the third way of thinking about a firm, right? So if you look back, right? If you look back to the firm structure, right? So here, a very important decisions that the founders are making is to hire people, right? Is to hire people. It might comes naturally for you, right? Um, for these hiring decisions, right? When people graduate, right? When we graduate from our schools, we need to find a job. And a lot of times we take this for granted, right? We want a full-time job, right? And because it pays more than part-time jobs in general and is more stable, right? So this is also something that the companies are thinking, right? So let's say Tom and Jerry needs bookkeeping, right? They need an accounting guy, right? So you can think of this as sort of a transaction, right? From Tom and Jerry, right? Between Tom and Jerry and the labor market, right? To acquire accounting services, right? So they don't have to, hire some accounting guy and give them a contract, right? Meaning that to make him become part of the company, right? They don't need to have a full-time employee, right? So one thing they can do is that, well, now we need accounting. Why don't we find one? Well, we pay him for 10 days of his job, and then we just let him go, right? We don't make them a full-time employee, right? So a lot of companies are doing this, right? They find contractors, and contractors hire these people to work for the companies, right? So for the company, these employees are not their full-time regular employees, right? Instead, they are, they are actually the employees of the contracting firm, right? So this is one choice that the companies can make, right? So, and just, let those people go. And if we don't need their service, and if we need the service again, we'll find someone again from the market, right? And the second choice is like what we take for granted, meaning that, well, let's, go to the job market. Let's find someone who suits our job, and let him stay in our company as a full-time employee, right? As a regular employee. And so we don't need to repeat this hiring process, this searching process again in the future, right? Especially for some service that we might, frequently require during our operation, right? So in many cases, right, the second way is proved to be, less costly than the first choice. Okay, so this is one reason that Coase in 1937, in his very famous paper of theory of the firm, proposes, right? So it is likely that, right? So what Coase says is that it is likely that, firm arises, or the structure of the firm arises, right? Or another way to put it is, the number of employees of a firm arises, right? Right. A firm with one single person is just, one guy, right? But per firm with 10 people is more likely, is more, similar to our impression of a firm, right? So what he says is that, firm arises because it's costly to make transactions like this, right? To require service from the market again and again, right? Then finding a permanent or relatively permanent employee and let him stay within the firm. Okay, so that's what he proposes to the emerging of firms, right? So basically, what we're saying here is that because long-term employment makes more sense for firms, right? In many scenarios, especially when firm requires this service repeatedly, and then the firm decides, right? So then the firms makes a decision to hire these employees as their as a permanent or relatively permanent part of a firm, right? So this is why firm arises. Okay, so this is how you understand transaction costs, which might sound very remote from a corporate finance, right? So transactions costs, the first impression should be, well, when you trade in a stock market, there are certain transaction costs, meaning that the brokers might charge you a fee for making a transaction, or the money, the price you get by making a transaction might be higher than the price you see right on your screen, right? So those are all types of transaction costs. But in the theory of the firm, this transaction cost refers to the searching cost, right, associated with finding a service, right, in the labor market, which will make it very costly for firms to repeatedly do this, right? Okay, so now we talk about three theories, right? Three explanations on why firm arises or why firm emerges, right? So these are all explanations, right, given by the previous researchers, and in different perspectives, right? They all make sense, right? They all make sense. So here, right here, after we have some basic understanding on where firms come from, right? Then here's basically how firms are, right? In terms of the different types. They ranges, right? As we know, like firms ranges from this by its size, and also the number of years it has founded, right? Generally, these two are quite correlated, right? And when firms are small, they generally started from a few people, right? If you are the sole owner of your company, right, you are the first type of a company, right, here on the right-hand side table, right? And if there are few of you that founded the firm together, then you may, the firm might run into a form of a partnership, right? And as number of owners increases, right, the firms might, change from partnerships to a limited partnerships, which, is different with the partnerships in terms of the, in terms of the liabilities, right? And then as the firm increases, furthermore, it might become something like a limited liability company, as corporation, and if you know it's like a public listed company, right, as big as a public listed company, they generally have a type of C corp, right? So I will not go over the details for different type of firms, but you know they're different because a big reason that you know you may have a firm with different types is because of their size, right? It's because of their size and because of the stage of the firm at the point of time, right? And in different stages with different size of the firms, because their advantage for liability and taxes, right? Liabilities and taxes in different at different stage for different forms of companies. So the firms may decide to choose different forms to favor their own situation, right? So if it's a very small firm and you don't want to pay a lot of tax, you don't want to be regulated, you don't want to be regulated as much as a C corporation, right? Meaning that you don't want to disclose your information, so you don't want to incur the cost of filing a lot of documents to the security to the government, right? To SEC, right? Then there's no point of being a C corporation, right? So just stay as partnership or limited liability company might be a better idea, right? So this is a lot of times associated with the size and the stage of the company. Okay, so but one thing to know is that the reason that a lot of conversations are focused on corporations is because these corporations basically C corporations and S corporations. Okay, so a large part of the corporations of this percentage is C corporations, right? So the reason that we often talk about this type of company is because it takes the majority of the market size, right? Of the market size or market cap of the overall, right? Of the overall economy, right? However, we should not ignore that in terms of the numbers, right? In terms of the raw numbers, 71% and even larger, right? Even larger, including 71%, 6%, right? Of the total companies, right? The number in terms of number of companies are, small companies, right? Small companies like sole partnership and limited liability companies and partnership companies, right? So in terms of these numbers, the large companies, there's relatively a small number of large companies, while there are so many, right? Small companies, right? Small companies in the economy. Okay, so here's the introduction, right? Here's the introduction on the basics of understanding of firms, right? So you might have never thought about firms or corporations or companies, right? In this sense, right? But I think these are very important and sometimes fundamental, right? Fundamental understanding on firms, right? So remember what the first one is. Right, the first explanation of companies, or why firm arises, why firm emerges, is that it's generally better for reaching a higher profit, right, than doing business by individuals, right, and competing with a lot of other individuals, right. And the second one is that, well, if you think about why people would want to work together, right, there must be some good discipline, right, or good contract between them and the company, right? So here I want to highlight that the contract is between the individuals and the company. Okay, it's not between these different individuals, right? It's always a contract between the firm and the employee, right? So this is what the contract theory says, right? So you have to have a good contract such that everyone, right, will want to make the best efforts for the companies, right? For the company, and then finally, right, there's a benefit for starting an organization like a company because, right, because if you hire someone, right, if you hire someone or hire some type of expertise from the labor market, right, in a relatively long horizon, then it's many times is less costly than to repeat this searching and hiring process again and again, right? So because of this high transaction cost, high searching cost, right, from finding the talents and finding services, sometimes it makes sense, right? To have organizations with firms and under which you have employees, who are hired relatively permanently to save this cost, right? Okay. So then we talk about firm structure, right? And there are different type of firms, right? And in C corporation, there are some things that we will talk about, right, in later slides, especially when we talk about the capital structure. Okay, so some highlights of the C corporations is that, because of hiring managers from outside, right, we will reach the C corporations can have the issues arising from the separation of control and ownership, right? Meaning that, if you hire a CEO from outside who does not have many or much ownership of the company, right? Then the CEO is likely to engage in agency, right? Agency issues, right? So meaning that he will likely, do something for himself, right? At the cost of other owners of the company, right? So that's related with the agency conflicts within the firm. However, it's not only between managers and other investors, right? It could also be related with a different type of investors, meaning debt holders and equity holders, right? And then in C corporations, there's something different with other type of corporation, which is the board of directors, right? And that the board of directors is supposed to be, a representative of shareholders who sort of monitor and discipline, right, the managers. Okay, right? Just because, as we just said, that the manager is likely to not own that much of ownership of the company, so that his decision sometimes needs to be monitored and disciplined by the board of directors. Okay, we'll talk about that more when we talk about CEOs and agency conflicts, right, in the later slides. But these are also something that you might find interesting or you might want to think about for a company. Okay, all right. So this is basically the theory of firms, right? Let's talk about capital budgeting, right? So hopefully you have a better understanding of firms right now than just to think about it as an organization of people, right? Which is true, but we care more about the conflicts, right, or the interactions between different agents in the organization than rather the business what we do, right? The organization does. Okay, so this slide is the first slide of capital budgeting, right? So capital budgeting is separated into three parts, right? The first part, right, as what the capital budgeting is trying to do, right? We want to make decisions on a company's investment. Okay, so first of all, we want to have value for different investment projects. Okay, we want to come up with a value for different investment projects. Right? Let's say a company is facing several opportunities. Right? So let's take an example. Right? So let's say we're talking about Tesla. Okay, so Tesla is maybe facing several investment opportunities, right? So making sedans, right? Making trucks. Maybe sometimes it will also make bicycles, and maybe sometimes it will also make a racing car, right? A race car. Okay, so here are all some potential opportunities for Tesla to do, right? How will Tesla decide which one, right, to take, right, or which ones to take, right? So the valuation is crucial, right? So the first part is about valuation in the sense that, we were going to start from the top of a capital budgeting table, which is the revenue or the sales that a company can make or expected to make by investing in this project, right? And we'll keep going and we'll subtract the cost, right? And we'll adjust for several accounting items, and we'll of course pay taxes, right? And then we're going to reach something that we call free cash flow, which is basically the residual cash flow that the company will receive, right? Basically as earnings after tax, right? And we're going to use the tool that we have talked about in the first lecture, which is the time value of money tool, and calculate the net present value of this free cash flows that a project will expect to receive for the company, right, in the future. And that's the first part's job, right? The second part, right, we'll talk about the second part of capital budgeting. We'll talk about that, facing different investment projects, which one should we choose, right? The truck or the race cars, right? So if we can only choose one, which one should we take, right? And if there are multiple of them, which ones should we take given our budget of resources, right? A lot of times our budgeting our budget of resources include like our human capital, right? Meaning that we have only 100 employees, right? Only 100 people that we can put in our car factory, right? So which kind of car do you want? How many of them to be working on, right? So if you want 80 of them to work on race cars, then you're only left with 20 cars to work on trucks, right? So this is something that you cannot change, right? Of course, you can hire more people, right? But that's another decision, right? And a lot of times the resources is associated with money, right? So here are just this amount of money that you can spend, right? So, well, there's no way to spend more money than you have, right? Unless you raise more, of course, right? So here's basically, when we have a resource budget, what are the rules that can guide us through making the decisions, right? And the third part of capital budgeting is to a special thing that we call real options. Okay, so that's something that cannot be directly accounted when we do net present value, right? Because it's something rather abstract and hard to value. The real options basically stands for the flexibility. Okay, the flexibility of an investment project, right? Some investment project can be stopped or can be paused in the middle and then resumed 10 years later. Okay, but some investment opportunities, once you stop, you can never resume it, right? Okay, so this is a difference, and sometimes a very important difference in the nature of projects, right? So when we compare different projects, we also want to take this kind of flexibility into consideration, right? Sometimes it can be very valuable for companies, these flexibilities. Okay, so this is basically the three part of capital budgeting. First part, valuation. Second part, investment rules, and the third part, real options. Okay, so let's get started. First part, net present value of the investment projects. Okay, so let's start with something that which we already know, right? So we already know that net present value can be calculated as the sum, right? The sum of present values of all future cash flows, right? So this is a summation notation, right? Meaning that basically meaning that this is just a short way of writing this long equation, right? This is basically saying that we want to okay, so here I think there's another term here. We want to sum up C starting from C0 right? Right, starting from C0, we want to sum up the present value of all future cash flows, right? C0, C1, which is the cash flow we expect to receive at t equals to 1, right? We need to discount it back to the present by dividing 1 plus r, right? And if C2 is the cash flow we're going to receive at the end of the second year, right? Then we need to discount it twice so that we get a present value, right, back at t equals 0, and so on and so forth. For a cash flow we're going to receive at t equals to n, right? At the end of the nth year, we need to discount it back to the present by dividing 1 plus r to the exponent of n. Okay, so and if we have present values of all future cash flows and we sum it together, then we will reach net present value. Okay, we will reach net present value. Okay, so the goal of this lecture is basically form a universal or a simple to understand way of how to think about businesses and how to end up with, how to come up with a different piece of cash flows in different time. Okay, and whenever we have cash flows, and if we know the discount rate R, then we have no problem of getting that present value. Okay. All right, so the outline of this lecture is like this, right? So we're going to get into some accounting basics, right? So just, some terminologies on different items, right? That's involved in doing capital budgeting, right? And a lot of these items are the same from, those in the financial statements that, the companies report periodically, right? So here, we basically use sort of the standard reporting rules or reporting standards of this publicly listed companies, right, who are required by SEC to periodically review their financial performance using these statements, right? So we're going to start from the top, which is the revenue or the sales of the company, to the bottom cash flows, right? So there are a few steps or important steps that we're going to do, right? First of all, we're going to calculate the earnings, right? And we're going to start from the earnings to get the free cash flow. And the third step is to get net present value from the free cash flow. And the final step, which is often very important, okay, which is called sensitivity analysis, right? Meaning that, we are basically forecasting the future, right? And we're not so sure, and sometimes very not sure, right? Very not sure about what's going to happen in the future, right? So we are going to, instead of giving an exact estimate, we're going to give an estimate with an error range, right? Meaning that we want to account for some uncertainty on the estimate or on the forecast of a certain type or certain parameter that we forecast. Okay, and then that will give us the sensitivity analysis, which is basically seeing how our conclusion of net present value is sensitive to different parameters, right? So if I change discount rate from 5% to 6%, will that give us a negative net present value, right? So basically that changed the decision that we're going to make, right? So if I change, the revenue from $1 million to $1.5 million, will that be a much better will that give a much better net present value or not, right? So we want to sort of adjust our inputs a little bit so that we're comfortable with our final decision, right? So this is what the sensitivity analysis is about. Okay, so let's start with financial statements of a company, right? So here, this is also something about, C corporations, right? Which is basically sort of the standard of, the corporate finance subjects, right? So we will, if we look at the reports, right, of the financial system, if we look at these financial statements, right, so they are actually the reports of realized financial performance, right, meaning that the reports is always about a period of time that has already passed, right? So the numbers are is supposed to be real, right? The numbers is supposed to be true, right? Which is truly what happens to the company, right? So sometimes the companies will engage in certain ways to manipulate the numbers in the financial statement, right? Sometimes the manipulation is legal, right? The manipulation doesn't sound like a good word, right? Sometimes they will make certain changes to the numbers or adjustment to the numbers, right? So sometimes the adjustment is legal, and in some other cases, the adjustment is not legal, right? So in this case, the companies are likely run into issues, right? With these manipulations. Okay, so let me look at the time. Okay, so excuse me. Okay, so there are certain requirements, right? These are the requirements by SEC on the publicly listed companies, right? So they're required to not only report an annual report, but also quarterly reports, right? Which are called 10K and 10Qs, right? So this is a website that you can go to search for any report, right? Not only 10K and 10Q, but also important other reports, right? Announced by or disclosed by all publicly listed companies. Right. So about the financial reports, there are generally three types of financial reports, right? Called balance sheet, income statement, and statement of cash flows, right? So balance sheet basically talks about, it's a snapshot, right? It's a snapshot of firm's asset, liabilities, and the stockholders' equity at the physical end, right, of a financial period, right? So if a quarterly report, it's basically at the end of, March, June, September, and December, right? For December, it's the 10K, right? For the other quarter end, it's called 10Q, right? So for some companies in the United States, they also have different quarter ends, right? So it's probably another month, right? Like in February or in January, right? So it could be different across companies. But basically, balance sheets describes different type of assets, liabilities for the company. Right. Income statement is a accumulation calculation, right? So basically for all the net income that the company has made within the period of that quarter or within the period of that year, right? What's the total net income, right? Calculated after adjustments, right? And statement of cash flow describes the use of cash of that company and how the company deal with the cash account, right? Okay. And so one thing that you might want to think about, right, is the numbers, right? The numbers in the financial statements, right? So there's one type of valuation which is called book value, right? So financial statements are book values, right? So those are basically the values, right, especially for assets, right? So how do you give an estimate of equipment that you have already owned after 5 years, right? So if you don't sell it, you don't know how much people are willing to buy for it, right? So in this way, right? So normally firms will have a way of keeping track of the asset values, right? Even if they're not trading those assets, they're not selling those assets, right? So this value is what we call a book value, right? So you can think of book value in an easy way as the value the company assigns from itself. Okay, so if a company thinks that the equipment is worth $1 million, right? No matter how much it can sell it for, then they can keep a book value of $1 million, right? So I'm not saying they can have any value for whatever equipment is like, but this is how they will have a certain depreciation system, right, for valuing assets, right? But this value could differ largely on how much they can sell it for. Okay, so this is the book value, right? So the financial statements, right, especially for the balance sheets, which talk about firm assets, it's all book value, right? It's all book values, right? So then on the other side, what is the meaning for market value, right? Market value is basically the transaction value, right? So if you make a transaction, meaning that say one day this factory A decides to sell one piece of its equipment, and the buyer of the equipment paid $1 million for this equipment, right? So the equipment will have a market value of $1 million, right? So that's the transaction value, right? That's what the market assigns the value for your assets. Okay, so that can be quite different from the book value, which is what the factory assigns its own equipment, right, by itself. And another thing is another difference is that we only acquire book value from those financial reports every quarter, right, at a quarterly frequency, meaning that a lot of things can change during the period, and this value is likely not very accurate, right? However, if you have a market value, so for example, like the stock prices, right, it's fluctuating at different seconds, meaning that it's very timely updated, and it's more likely to be a fair value when you think about the true value of the assets, right? So these are the different things, right? These are the difference between book value and market value. Okay, so here's an example of the balance sheet, right? I'm not going to go to details into this all these entries, right? As long as you know, right? So this is basically a table that summarizes different type of assets and different type of liabilities for the company, right? The stockholders' equity is supposed to be the difference between assets and the liabilities, right? Think about assets as the things that a company owns, right? Think about the liabilities as the responsibility for the or the duty for the companies to pay, right? So the difference is basically what remains for the investors or for the owners for the company, right? So that's why it's called equity, right? So that's what's remained between what you own and what you have to pay, right? Okay, so income statement, right? Here's another example. It's a lot shorter than the balance sheet, right? So it's basically starting, right? The capital budgeting table looks a lot like the income statement, right? So we're gonna start with the sales revenue, right? So this is the money that the company has made, right? We're gonna subtract several type of expenses and costs, right? Here, salaries is one type of expense, right? Rent and utilities and the depreciation on the machines, right? And we're going to end up with something that's called earnings before items and tax, right? So EBIT here, right? You want to pay attention. This is something that you need to remember, right? EBIT is earnings before interest and tax, right? And if you pay interest, after you pay interest, it becomes EBT, right? So there's no I here, meaning that you have already paid the I out, which is the interest expense, right? Then it becomes EBT, which is earnings before tax, right? And after you pay taxes is basically earnings, right? There's no earnings before anything, right? It's basically an earnings. And another way to say earnings is you can call it net income, right? Different people call it, it can be different, okay? And then, there's some terminology associated with earnings. Right? For example, earnings is always, talked about in a per share basis, right? Meaning that EPS, right? So if you trade stocks, then you probably will care more about earnings per share, right? Because if a company has too many shares, then basically for each share, right, as an investor of a company, you actually are entitled to a less amount of earnings or net incomes from the company, right? So EPS is one standard to think about the profitability or the performance of a company's stock, okay? And okay, so one thing I want to highlight here is that the income statements reports the firm's operation performance over the past physical quarter or the past physical years, right? So it's all past information. Okay, it's not all past information. It's not predicting, right? And finally, for cash flows, right, we have different three type of cash flow activities, right? So related with operating, related with investing, right? Operating is basically how related with the firm's main business, right? So if it's Apple, then it's about manufacturing iPhones, about manufacturing computers and stuff like this, right? And there are also cash flow from investing, right? So usually companies will invest in, it will invest in capital, right? It will invest in, for example, Apple may need to build a lab for a certain type of model that it wants to, develop, right? It wants to develop, right? So a lot of pharmaceuticals also have invest a lot of money in their labs, which will remain as the capital, right? As the capital of the firm. So that's what we call capital expenditures, right? And also there are cash flow from financing activities, meaning that is related more to the financing, right? It related to debt and equity, and the cash flows using that, right? So if the company buys back stocks, right, it needs to account for the money it spends in purchasing back the stocks from the open market, right? And if the company issue new debts, right, it needs to adjust for the borrowings of longer term debts, right? So here are this, right? And then we will find the net increase and net decrease of the cash account, right, at the end of the physical quarter, right? So this is what a cash flow statement of cash flow is about. Okay, so we saw financial reports, right, which whose a lot of terminologies we were going to use in our capital budgeting, right? And as I said, the capital budgeting looks very similar to the income statement of the financial reports, right? However, we should know that financial reports are always about the past, while capital budgeting is always about forecasting the future, right? So nothing in the capital budgeting process is for sure, right? Because we're all forecasting the value that will happen in the future, right? That will come in the future. And another thing in capital budgeting, which is very different from financial report, is that generally, right? For now, we don't consider the leverage, right? We don't consider the leverage in capital budgeting, meaning that we don't care where the money for the investment is from, right? Whether we sell equity to raise the money or whether we we borrow debt, right? We increase debt to raise money for the investment. It does not matter for now, okay? So let's say we want to value the investment project independent of its financing resources, right? So when we compare between different projects, we want to make sure this happens. Okay, we want to make sure this happens. Okay, so this is one thing. Another thing about capital budgeting. So if we don't consider leverage, then there's basically no interest payment, right? So we will not account for interest payment in capital budgeting. And here, right, so leverage does not change the nature of the business, right, while it only amplify risk, okay? So this is basically saying that, when in normal cases, right, if, we don't require so much of a leverage that it brings in, a distress on a firm, right? So we generally consider, right, the leverage is not important for making the decision to choose or to determine whether we want to take the project or not. Okay, so we will consider debt financing in the future when we talk more about valuing a firm, right, rather than valuing an investment project. So let's think about, right? Let's think about the capital budgeting process. Okay, so it's a long word, but it's actually a quite simple process. Okay, so let's say we have our own business, or you have your own business, right? Which is a new coffee shop in our hub. Okay, so if you want to open a new coffee shop, right? What are likely the cost and the benefits, right? That you're likely to encounter, right, during the process of your coffee shop, right? Let's say you want to open it for like 5 years, and then maybe find some other business to do, right? At the end of the fifth year, you will somehow sell the coffee shop, or to some other people, or you will just shut it down, right? And liquidate whatever you can do, right? Basically, forget about it after 5 years. Okay, so if you think about this, right? When the coffee shops operates normal, right, between the first year, the end of the first year, right, to the end of the fourth year, right? So we should expect a sort of a constant cash flows, right? So some different things might happen at the beginning and at the end of this project, right? Meaning that at the beginning, there might be certain type of costs that we will encounter once for all, right? So there are some other things that we might encounter at the end of the business after we decide to terminate it, right? So here is basically how we can easily identify the transactions or the items that we want to think about, right, in a capital budget process, right? We can separate it into 3 parts, right, or 3 stages, right? The first stage is when a company or a business just started, or think about it as a project just started, right? There's some initial outlay for your coffee shop, right? So one example is that, well, first of all, we need to find a place, right? We need to hire, we need to rent a space in a hub, right, for our coffee shop, right? And we need to purchase this equipment, right? We need to purchase coffee machines, right? And we also need to incur some other development costs, meaning that we need to decorate the room, we need to do marketing to let everyone know our business, and many other things, right? And one last thing, which is also quite important, is that we need to increase our inventory, right? We need to buy coffee beans, we need to buy cups and napkins, right? So that we can service people, we can serve those to people, right? And so these are all the things, or all the unique things, which are quite different from what we will encounter in the other stages, right? When the business starts to operate normally, right, we will be at the stage 2, right? So the ongoing cash flows will be quite stable, meaning that we are expecting to receive constant revenues, or revenues that grow at a constant pace. We will encounter cost, but it's likely to be the same in different years, so that the taxes will also be the same. And if we maintain a level of net working capital, meaning that if we maintain an inventory of coffee beans or other raw materials, then there's likely not much change in our net working capital, right? And finally, right, if we determine to terminate this project, we can sell our equipment, right? But we might also encounter some shutdown cost, meaning that there is some money probably we have to pay to shut it down, right? So sometimes if we rent our space, right, it's in the middle of a contract of our renting contract, we might need to close the contract earlier and compensate the owner of the contract some money, right, to close it down in the middle of it. And finally, right, it's likely that we observe a decrease in the net working capital, right, in the coffee beans, right? So we probably want to use it out, or we'll probably have to throw it away, right, if we can't use all of them, right? So that's what we'll generally see, right, at the end of the project, or at the end of the business, right? So this is basically the big picture, right, of a business capital budgeting process, right? So there are 3 different stages, right? And there are likely three different kinds of cash flow patterns that will likely happen in different stages. Okay, so what we'll do, right? What we will do is to start with everything that we can forecast, right, as carefully as possible, right? And we're gonna step one, right? Step one, we're gonna arrive at incremental earnings, right? Here, incremental basically just means annually. Okay, just means extra, right? It's extra basically means it's on top of the previous years, right? So that's why it's called incremental, right? So basically for each year, right, you can think of incremental earnings or incremental anything just as earnings, right? And then we're gonna arrive from earnings to free cash flow, right? And then if we know the discount rate and it's constant across the year, then we can arrive at net present value, right? Okay, so we need to consider a couple of different things, right? Especially for the beginning and the end of our project, right? And we will talk about that, over here. Okay, so incremental earnings basically means within each period, right? So how we gonna arrive at incremental earnings is like this, right? We start with revenues, right? For simplicity reasons, right? We're just gonna consider some major parts, right, of the cost or expenses, right? So we're gonna start from incremental revenue, right? We deduct cost of goods sold, so that we arrive at the gross profits. Okay, gross profit. And then we're going to deduct we're going to deduct the selling, general, and administrative expenses, right, which we call SG&A, right? And then we're going to deduct depreciation, okay, which basically means, the amount of value that's lost during the usage or during the time period for our equipment and for our other type of assets. Okay, and after we adjust these 2 things, we're going to arrive at EBIT, right, earnings before interest and tax, right? And since we don't consider interest payment, right, in capital budgeting, we only need to take care of tax, right, to arrive at net income, or something that we call incremental earnings here. Okay, so net income, earning, incremental earning, they all mean the same thing. Okay, so in short, incremental earnings will be, starting from revenues, right, less cost of goods sold, less SG&A, less depreciation, right? And then we want to subtract tax, right? Usually tax is basically the EBIT times the tax rate, right? So say like 20%, 35%, right? Depends on the nature of a company, right? And after deducting the tax, right, by multiplying 1 minus tax rate, we can reach the final incremental earnings. Okay, so this is how we do incremental earnings. And Linksys example, right? So let's take a look at an example. Okay, so this is a company called Linksys, right? And it's developing a product called HomeNet. Okay, and this HomeNet is expected to sell for an amount of 50,000 units, right, per year for the next 5 years. Right, the whole price of HomeNet will be 260, right, 260 per piece, and the cost of goods sold will be $100.10 per unit, right? And to verify the compatibility, Linksys must also establish a lab for testing, right? So this is basically something that it has to do at the beginning of the period, right? So basically a spending of $7.5 million on new equipment, which will be depreciated, right? Remember, this new equipment costs this much. However, to adjust for depreciation, right, we need to use something called a straight line depreciation method, meaning that the value of the equipment decreases linearly, right, from t equals to 0 to the end, right, to the end of the 5th year, right? Linksys expect to spend $2.8 million on rental costs for the lab, right, per year, right? So this 2.8 is basically you can think of as SG&A expense, right, as well as on marketing and the support for product, right? So the total expense is $2.8 million. The marginal tax rate is 40%. Okay, so after you deduct everything, you need to pay 40% tax to reach the incremental earnings. Okay, so this is the way we're going to do this, right? So my recommendation is that we draw a table like this, right, to account for both the timeline and the items that you want to deduct or adjust, right, from the top to the bottom, right? So after calculation, right, we can find that the revenue should be 50,000 units times 260, which is the price each piece, right, which will be $30 million, right? The cost of goods sold in the same manner, right, will be $5.5 million, right? Incremental SG&A will be 2.8 as we described. And so for the next 5 years, right, we can calculate depreciation using the linear depreciation way, or straight line depreciation method, right? Meaning that for 5 years, we're going to assume that the $7.5 million equipment is going to depreciate to a value of 0 at a constant pace, right? Meaning that for each year, we're going to end up with a depreciation value of $1.5 million. Okay, so and a tax rate of 40%, right? So let's say here we haven't really done anything about this 7.5 outgoing cash flow yet, right? So this happens at t equals 0, right? But the point of time that we start to receive revenue, right, is recorded at the end of each year, right? Meaning that after we start selling, at the end of the first year, which is 1 here, right? This is at the end of the first year. We're gonna receive a revenue of 13 million, right? And this is going to remain constant for the next 5 years. Okay, so at the end of each year, we're gonna receive a 13 million revenue within that year, right? Within that year, and it's the same for cost of goods sold, right? Meaning that I have a minus sign in front of it, meaning that we should deduct it from revenues, right? So with the minus sign, we can just add it up, so that the gross profit is 13 minus 5.5, which will be 7.5. Okay, so gross profit, which is different of this two, right? So you don't have to have this line, remember, right? So here is just want to show you, right, the intermediate steps, right? So gross profit is 7.5, right? And we want to subtract $2.8 million for annual expenses, right? And we want to distract, we want to subtract, right? We want to subtract depreciation of $1.5 million per year, right? So after subtracting these two numbers, we're going to arrive at 3.2 from 7.5. Okay, so meaning that the earnings before tax is 3.2 per year, right? And with a 40% tax rate, we need to pay $1.28 million tax. It's a lot of tax, right? It's a lot of tax. And we're going to arrive at the incremental earning per year for 1.92. Okay, so this is where we're going to end up with incremental earnings, right? So this is how we're going to calculate incremental earnings, right, from year 1 to year 5. Okay, okay. And so there are a few things, right, about depreciations, right? So there are certain ways to do this depreciation, right? So the point of depreciation is to, give a relatively fair value to your assets because they depreciate over time. Okay, and it's not fair to always have a brand new equipment, right? Throughout the years, right? And one way to adjust for depreciation is to use this straight line depreciation method, right? So a lot of time, and so some other method to use by a lot of companies is accelerated depreciation, right? Meaning that this is a table for accelerated depreciation, right? Meaning that you can actually assign a higher depreciation value for your assets at the beginning years of the horizon, okay? And there is a benefit for doing that, right? So here, for example, if you have a horizon of 4 years, right, you can actually do depreciation in the first year, which is 33%, right, of your value, right? So if the equipment is $7.5 million, then 30% of it is, maybe $2 million, right? More than $2 million. And then you can assign a 44% of its total value in the second year, okay? And then in the third and fourth year, there's only about 20% of the value left, okay? So there's the benefit for doing this is that, depreciation, the higher depreciation, right, in the beginning can give you a higher cash flow, right? So why does it give you a higher cash flow, right? Because you pay less tax, right? So remember, we deduct depreciation before we calculate tax, okay? So a higher depreciation in the beginning, right, can give you a smaller tax payment, right? Can give you a smaller tax payment in the beginning, right? And based on the time value of money rule, right? So if we have a higher cash flow in the front, right, we're gonna have a higher time value of money, right? So this is how depreciation works, right? So, but there's a maximum for you can do it, right? So here basically are the maximum value you can assign to depreciation using accelerated depreciation method, right? So you don't have to fully understand all of this, right? So it's here for your knowledge, right? So it's just, it basically says, there's some flexibility for you or for companies to do, right? In terms of deciding the value of depreciation for each year, okay? And there's certain reasons for doing it in different ways. Okay, so for the Linksys example, right? So like if the acceleration is, if we use accelerated depreciation, right? Then the depreciation will be moved, not only moved ahead, but also will be higher, right, in the beginning, right, than later periods, right? So in this way, the net present value we calculated, right, assuming the same discount rate, will be higher than the cash flow, and then the net present value that was calculated using the straight line depreciation, right? So that's the point. And there are also some details, right, on taxes. Okay, so a lot of the times it's not just a straightforward, 40% tax rate on companies, right? So the 40% actually stands as an effective, right, as an effective tax rate, right? So for companies that earns relatively a small earning, the tax rate would be relatively smaller. However, when you reach a higher tax bracket, your tax rate will increase by a lot, right? And the tax are collected not only by the federal government, but also a lot of times by the state and sometimes the city governments, right? So there are different layers of tax that you can think about for a company, right? So that's why tax is sometimes a very important thing for a company to consider, right? In terms of which type of company it should be, and what kind of leverage it should have, and many other company decisions, right? So here is a website for you to find more information on tax, but we're not gonna go into the detail for this. Right? Okay, so that's step one, to calculate incremental cash flows, right? And here's the step two, right? So after we calculate incremental cash flow, we can actually continue to calculate the free cash flows, okay? And the way to do that is that we're gonna start with the incremental earnings we have, right? And we're gonna add depreciation back, right? And we're gonna adjust the capital expenditure in the beginning, right? Normally in the beginning of the in the beginning year, right? And we're gonna subtract net working capital, right? Or we're gonna subtract change in net working capital. Right, here, let me add this, change in net working capital, right? Or you can think of this as I think, or the triangle, right? So that's stand for the change in net working capital, right? We need to adjust for capital expenditure and change in net working capital, right? So to make it easier, right, we're not going to talk about a change in net working capital, right, in this class, but we do need to consider capital expenditure, okay? So in the problems that you're gonna receive, right, for you to work on from this class, you can assume that the net working capital is the change in net working capital is always zero, right? But it does not mean that this is not important. Okay, it's just for simplicity, right? We're gonna assume it's zero throughout the process. Okay, so one question here is that, well, I remember that when calculating incremental earnings, we subtract depreciation, right? Why do we add it back here? Right? Why do we add it back here, right? To reach the free cash flows, right? So one answer is that cash flows, depends on the cash items, meaning the money that you actually spend out of your pocket or receive in your pocket, right? However, depreciation is not a cash flow item. Okay, depreciation is not a cash flow item, and we deal with depreciation before tax only for the tax purpose. Okay, so this is more related to accounting, why they deal with this, right? But one reason we specifically do subtract depreciation before tax is that we want to estimate tax, right? We want to estimate tax when depreciation is subtracted from the earnings. Okay, so and to adjust for the subtraction of depreciation before the tax, right? We want to add depreciation back, right? We want to add depreciation back. So that's sort of like a a very irresponsible way of explaining depreciation, but in many cases, right, the depreciation is there solely because of tax purposes, right? Solely because of accounting purposes to calculate tax, okay? To calculate tax, right? There's something called depreciation tax shield, meaning that, for years you have a higher depreciation, you will have a higher, tax shield, meaning that you will pay, you are required to pay less tax in those years, right? So that's how depreciation works, right? However, right, because we're looking for a cash flow item, right? We're looking for the free cash flows in the end, and depreciation is not something that's directly related to cash flow. So we need to add it back, right, to on top of the earnings after tax, right, to adjust for this depreciation, right? Right, and another thing we need to remember is we want to take the capital expenditure off, right, which normally happens at t equals 0, right? So let me show the example. All right, here's a slide about net working capital. You're free to skim it yourself, right? So here's how we adjust for capital expenditure and depreciation. Okay, so we're gonna reach 1.92, right, for incremental earnings, right, in the previous slides, from year 1 to year 5, right? And we're gonna add 1.5 depreciation back, right, because this is what we have subtracted, right? This is what we have subtracted when we calculate incremental earnings, right? So one thing we're gonna adjust is right here, right? Remember, before we start selling this equipment, the company starts selling these products, right? They need to build the lab first, right? So the lab comes first at the beginning of the period, and then the product can be produced, right? So this is something that happens at t equals to 0, right? At the beginning of the first year, right? We're gonna encounter expense, right, or a capital expenditure, right here. So so this is why we deduct, we have a minus 7.5 at the beginning of the first period, right? At the beginning of the first period. And that's going to translate into a negative 7.5 incremental free cash flow at t equals 0, right? At t equals 0. And then after adding depreciation back to incremental earnings, we're going to reach incremental free cash flow of 3.42, right, from year 1 to year 5. Okay, so this is basically how we start from incremental earnings, right, to our final wanted incremental free cash flow or free cash flow, right? So if we know this, right, then our net present value should just be, plugging those cash flow numbers in our net present value formula, which will be, something like this, right? Which will look something like this, right? And if we assume a discount rate, or right here, a cost of capital of 12%, right, which is basically the discount rate we're going to use, then the net present value will be 4.83, right, 4.83. So this is how we determine free cash flow, and then determine the net present value, right? So here's one slide about liquidation value. We're not going to talk much about in this in this course, right? But feel free to look at the liquidation values, right? So in the homework or exams, there will not be a liquidation value, right? There will not be a change in net working capital, but it's good to know, right, what will happen at the end of the project. Right, so we just went over how to calculate net present value, right? So basically, this is just an abstract formula of what we just did, right? And one issue is that, how do we determine the length of t, right? So for a project, right, if you have something in mind on how long you want to open the coffee shop, right? For example, 10 years, right? Then use t as 10 years. Right. So this is generally for a specific project. This is generally a finite number, right, with a terminal value, right, representing its worth in the long future, right. So, and also, well, the effect, right, the effect of the changes in t is smaller when time periods goes on, right. So there's likely not much difference, right, between a project that lasts for 30 years and a project that lasts for 50 years, right? Because the future values will be heavily discounted, right, when it's too far away in the future, right? So normally we will have a time period which is properly associated with the nature of the project, right? Okay, so here's an example. Okay, so we're going to talk about the examples in the live session, right? But feel free to get familiar with it, and see if you can do it yourself first, right? And so when we talk about it in the live session, you know what's going on, right? So this is one example, right, with a table similar with what we have talked about in the LINC example, right? And here's another one. Right? Okay, so for the last step, right, after calculating net present value, right, this is actually sometimes, well, this is often a very crucial step, right? So we don't want to just end up with one single value because it's based on a lot of assumptions that we make, right? Remember, we made an assumption that the product will sell for 50,000 units, right, per year, and it will sell at a sale price of 360 or something like that, right? So all the left, the parameters on the vertical axis, right, are basically the assumptions or sometimes the key assumptions that we make, which can determine the free cash flow, right, which can be very influential to the free cash flow and the net present value of the company, right? So one thing that we can do is to see, right, if we give it slightly wiggle room, right, on different parameters or on different inputs, how will that change our final conclusion, right, in terms of the estimate of net present value, right? So this is basically what we call a sensitivity analysis, right? How sensitive, right, to measure how sensitive net present value is on regarding different inputs, right? So if we change, right? So for example, if we look at the first thing, units sold, right? So if we change the number, our prediction, right? If we change our prediction of the number of units sold from 50,000 to 35,000, right? To 35,000, then holding everything else constant, we will reach not an NPV of 2.86 anymore, and instead we will reach a net present value of likely between -1 to -2. Okay, and what does that tell us, right? It tells us that if our forecast of unit sales could be as low as 35,000 per year, then maybe we should not take that project because it will make our net present value goes way below zero. Okay. However, if we oversell those products, right, meaning that we sell more than what we expected, right, and reaching to 65K per year, then that would be a really good project because the net present value is likely between 6 and 7 over here, right, which is much higher than 2.8, right. So, and for sale price, right, similarly, right, if our comfortable zone is between 240 and 280, and that's not going to be a problem, which because on the extremes on both extremes, right, the net present value will still be positive, meaning that it's still a good project, right? That's which a different conclusion that we will have on the assumption of unit sales, right? Because on the left extreme of unit sales, we will change our decision, right, to not take the project anymore, right? And similarly with other three parameters, right? So if we change a little bit, how is that going to affect our conclusion, right? The answer is likely no, right? Between a 15% and 10% cost of capital, we're okay, yeah, because it's always going to reach a positive net present value, right? So this is basically the point of sensitivity analysis, right? To see how different parameters affect the overall outcome, right? If there's an error in the assumptions or in the forecast of those parameters, right? Sometimes, so this is one dimension, right? Remember, we talk about one thing, right? Holding everything else constant, right? Sometimes you can do it in two ways, right? In two dimensions, right? So if we change unit per sales and sales price at the same time, how will that, give the outcome of net present value, right? So that will not be like a line anymore. It's probably like a two-dimensional graph, right? A curve for the final outcome. Okay, so this is the point of sensitivity analysis, right? So this concludes the first slide, right? This concludes the first slide for capital budgeting, which is basically about how to reach, right? How to reach the free cash flows, right? How to reach the net present value, right? From our basic assumptions on all the crucial items of a company's businesses, right? So we start from revenue, we get to earnings, we get to free cash flows, right? After a certain adjustment, right? We calculate net present value and we do sensitivity analysis, right? So two things that you may want to pay special attention in this, capital, in this, well, you can call it a capital budgeting process, is about depreciation, right? It's about understanding on depreciation and tax, right? So a lot of times for simplicity, we use the most straightforward methods, right? We calculate tax using an effective tax rate, right? We adjust depreciation, right? We calculate depreciation using straight line method, and we adjust it by adding it back, right, to earnings, right? So we get free cash flows, right? So these are the two issues, or not like the two complications, right? Or two things that you want to pay more attention to in capital budgeting. Okay, and we will also in the live session talk about how to realize this in a case, right? Which you will need to do the case report with. Okay, so that's it for this lecture, and hope to see you in the live session.